All right, Nick. Well, we're back at it again. I, of course, am doing this one from the road, but this is part 3 of our private equity and pest control series. And today I want to talk a little bit about the benefits and the risks of partnering with private equity firms. About 5 years ago, when private equity really started to get active in the pest control industry, I think a lot of folks just looked at private equity as a exit opportunity, right? A lot of guys weren't really thinking about partnering with private equity and juicing returns and getting a second exit here in the future. But we're starting to see a lot more of that. And I think over the next 3 to 6 months, I think a lot of folks here in the industry are going to see a relatively new phenomena in this space, which, traditionally the majority of the transactions with regard to private equity in pest control have been controlled transactions, or almost, whether they're controlled transactions or complete 100% change of control. I think over the next few months, we're going to start to see some minority investments and growth equity investments in this space. I know we talked about it a little bit before in our introductory section 1, but today, why don't we kick off on the risks and benefits? And I think maybe starting with the benefits might be a good place to start today, Nick.
Yeah, I think that is. And as you've mentioned, as private equity has garnered far more share of the transactions, I think it's an important topic for owners in the pest control industry to really understand. And one of the first benefits that you and I have talked about, more extensively over the past year is really the fact that private equity firms, private equity funds are paying the highest multiples right now. And so that's an obvious early financial benefit that's currently occurring in the marketplace, whereas strategics might want to pay 10, 12 times EBITDA, whereas private equity firms are paying anywhere from 14, 15, 18 plus times EBITDA at times to acquire these businesses. So clearly valuation at this juncture is a benefit of partnering or being acquired by private equity. Do those numbers make sense to you, Paul?
Hugely. And you hit on a great point. So I want to give an actual real live example of a transaction that took place within the last 6 months. Here in the pest control space, one of the clients we took out to market, we ran a formal process. And when we got toward final rounds of bidding, Nick, a lot of the strategic acquirers were kind of at the $80 million range on this particular transaction. And we also had some private equity firms in at roughly 80, 85 million. When we got into final round bidding, the transaction ultimately turned out to be a $100 million transaction with the sellers rolling 20% of the enterprise value, or 20 million, into the transaction, netting them 80 million in proceeds at the closing. And so these sellers actually did not really care to partner with private equity. And quite frankly, they were on the older side, and they looked at it and said, we want to be able to sell this business and get out. They effectively got a $20 million free roll, because if you think about it, if they turned around and sold to one of the strategics for 80 million bucks, that would have been it. But instead, they were able to have their cake and eat it too. They got 80 million up front, and then they got 20% of enterprise value, or 20 million in dollar terms, rolled into NewCo. And that platform might ultimately take that $20 million roll of equity and turn that into another 100 million bucks, potentially, right? We don't know what the future holds, but that's a prime. You raise a very good point, a point that I didn't even think about prior to getting on this session with you here today, is that, private equity has certainly been willing to pay, in many cases, more than what strategics have, particularly in the last 3 or 4 years.
Yeah, that's a good point. And it really goes into, I think, a second benefit in the example that you mentioned, is that if you're acquired by private equity and you do end up rolling a portion of the equity into the larger private equity-backed pest control company, it does give you that opportunity, whether you're young or old, to take some money off the table and really reduce your financial risk substantially. But yet, since you still have an ownership interest in the entity and the ability to manage that enterprise, grow it, and potentially earn multiples of your investment on that particular ownership stake, I think that's another huge benefit of partnering with private equity. And just to sum that up, it's taking money off the table, lowering your risk so you don't have to wake up to a phone call related to an accident. An employee has your truck somewhere doing something foolish, right? A class action lawsuit. All of these things that come up in the middle of the night for owners, that risk gets substantially reduced, yet you can still make money on the equity roll.
That's a great point, Nick. And one of the things that we touched on in earlier sessions is that these private equity funds tend to be, fixed duration funds of 10 years. And so a private equity firm will raise money on the upfront, spend the first couple of years investing in that, going out buying platform businesses, investing that capital, then growing those portfolio companies by doing add-on acquisitions. And at the end of the fund, they're looking to harvest that, right? Turn around and sell those investments to other acquirers or otherwise take them public. So when you think about rolled equity, it's really important. And one thing that I suggest every one of our clients do, and we're going through this process, is really pay attention to where you're getting involved with a particular private equity backed acquirer. And what I mean by that is, we had some conversations just the other day. Somebody called us up and said, hey, we just signed a letter of intent with a private equity firm and we're not sure if we made a mistake or not. Can you take a look at this? And this is a classic example, and I feel like I have this discussion every week where, I looked at this particular transaction and I said, I think you're leaving $20 million on the table.
Wow.
And they said, well, we're going to roll a significant amount of equity. And so we'll be able to, they said, we'll be able to get a second bite of the apple, but they're already multiple years into this investment. And so they're viewing the fact that the private equity firm itself said that we might get out within the next 12 months. And so if they're intending to get out within the next 12 months, you as a seller rolling equity, you're not buying low and selling high. You're effectively buying high and maybe hoping to sell a little bit higher when you get to the tail end of an investment. So it's important to think about the vintage of the fund, where the investment in that platform comes from a timeline, on the actual timeline or the duration of the life of the fund, in order to determine whether or not, hey, the hold period's 1 year, 3 year, 5 year. The longer the hold period for that investment, the more potential upside you'll get. It's akin to being like an early investor in Facebook versus somebody who's investing in Facebook once Facebook is already a publicly traded company, for example. Mm-hmm. So great point, Nick.
Really, the rolled equity component can be a benefit and a risk. And it takes careful analysis to understand where your company falls into the life cycle of that particular private equity firm, their pest control roll-up company, and the life cycle of the fund.
Yeah. And, clearly from my perspective, Nick, as a sell-side M&A advisor, we pay a lot of attention to that. But one of the things that I appreciate what you and your team do for our clients is you're able to, separate yourself from the day-to-day market that myself and my team live in and take a step back and run some numbers for your client to really think about. And you ask a lot of the right questions like, hey, where is this particular private equity firm in their investment life cycle? And let's try to back into what this rolled equity could potentially be worth. And again, it's forward-looking, it's impossible to determine, but at least you're able to give them a sensitivity analysis that actually purports with real life, mm-hmm. as opposed to, I think sometimes private equity firms, when they're pitching sellers, can be dramatically over-optimistic, not because they're trying to lie or materially misstate anything, but they're looking at their historical track record saying, like, based on our historical track record, this is what we should do here, which is, as we all know, not necessarily the case.
Yeah, no, that's an interesting point. And I think having that quantitative backbone that's provided with that scenario analysis really helps owners process the decision on being acquired by private equity, and if so, how much equity they're actually going to roll and what could be the potential outcomes. I will say that in that scenario, there's also substantial opportunities to reduce the capital gain taxes on the rolled equity if that ends up producing a gain. And we won't get into all of those here, but in some cases, you can actually eliminate the capital gains tax on rolled equity gains. So in thinking about some of the other benefits, Paul, where do you think there are, other benefits to folks being acquired by private equity?
I think oftentimes comes down to the goals and objectives of the shareholder. And, whenever we have, for the most part, when our clients come to us, they are not thinking about private equity versus strategic. They're thinking like, hey, it's time for me to sell this business. Now, there is a small minority of our clients that come to us and say, hey, listen, I've got a $50 million firm. I've kind of built this, I've taken this as far as I could take it, and I want to partner with somebody that has the financial resources, the capabilities, and the know-how that I don't have. I want to ultimately take this business public. And I know some people are watching this giggling, but you do have some friends out in the industry that really actually want to take a pest control company public. But for the most part, Nick, these are guys that are coming to us because they ultimately want to monetize their investment in their pest control business. And so for me, though, I look at it and say to myself, once I determine what the objectives are of the shareholders, when we take a business out to market, typically we are going to private equity firms and we're going to strategic. So I love to run broad processes. I like to get full price discovery. And usually the conversations I have with my clients are, we never ever know who's going to be willing to pay the most for this asset. So instead of making any assumptions, let's take a business out to a competitive sell-side process. Let's see what the private equity firms say. Let's see what the strategics say. Let's see what the actual numbers, what the numbers on the board say. Once we get in that sort of position, you might potentially find, as a seller, you might find yourself in the situation, as in the example I just gave a few minutes ago, which was like, hey, you've effectively got an $80 million business, but here's a private equity firm that wants to pay you $100 million for it, and you're going to roll 20 of that. You're still getting your 80, and now you've got 20 in value that could potentially turn into 100 million. We don't know what the future holds. But I think, Nick, to really answer your question, one of the benefits of private equity is the whole risk mitigation aspect for the guys that do want to continue to grow a business. They want to stay on for another 3, 4, 5, 10 years. They want to take some capital off the table today. They want to stay involved and continue to run their business, right? They want to be the president of this pest control firm. But they want to pull some capital out today. You can't do that with a strategic acquirer. Rentokil's not going to come in and buy 60% of your business. Terminix or Orkin's not going to come in and buy 80% of your business. Some of those firms have attempted to do that historically, but that's usually not the case. But a private equity firm will put you in a position where you're able to actually sell 60% of it and retain 40% of it. And the 40% that you retain now potentially becomes more valuable just because it's part of a larger, less risky enterprise, right? And so not only do you have the aspect of private equity sometimes being willing to pay more, but you also have the ability to get very creative with the transaction structure that you cannot do with a traditional strategic acquirer.
That's a good point. And for the younger owners out there, I mean, I've really seen it invigorate certain owners where they now have a bigger capital base behind them. They have the ability to make acquisitions and be aggressive about those acquisitions and how they're pursuing growth via acquisition. And also just being around different, potentially sophisticated folks who are either running other private equity firms within that private equity fund or firm, but then also some of the executives can be, quite proficient in terms of providing additional management guidance or operational or administrative support. So I've really seen some owners, they're like, I love private equity. I'll always want to work for a private equity firm after I do this. So it runs the spectrum, though, I would say.
If the first benefit is private equity, at least in this market, has tended to pay more. The second benefit is the ability to get creative and do a partial transaction, meaning you don't have to sell 100% of it. I think the benefit that you just raised, maybe being our third benefit, the private equity ecosystem. So when you sell to a private equity firm or your partner, you sell 60% of your business or you sell 100%, when you get part of that ecosystem, you're dealing with a firm that not only is larger than yours, but private equity firms, as we discussed in past segments, owns a portfolio. And so now you, as the CEO of a private equity portfolio business, will have the opportunity to spend time with CEOs in other businesses, sometimes very related and sometimes very, very different, right? You know, you might be a pest control CEO owned by a private equity firm that also owns a fashion house and also owns a digital marketing agency and has a variety of different businesses. And you'll be able to spend time with those other CEOs, compare notes, and learn, I think, a lot of very, very valuable lessons from your colleagues in other industries, operating other businesses, all under the same umbrella, so to speak.
No, you're absolutely right.
So Nick, in addition to the ecosystem, which I think is actually a very, very important benefit, what are some other benefits of partnering with private equity firms?
Yeah, you know, we did touch on capital and the availability of capital. The differences being where when you're a small enterprise, let's say 10, 15, even 25 million in revenue as a pest control company, your access to capital is very different than if you're a multi-billion-dollar or multi-hundred-million-dollar private equity fund. Okay. And so having that access to capital is really another benefit of partnering or being acquired by a private equity firm. And so think about that for a second. You know, oftentimes from owners that I work with, I hear about this frustration in that if we just had more cash, we could run another door-to-door team. We could, you know, make some acquisitions that strategically could increase our route density. But frankly, we just don't have access to capital, and we don't want to continue to pour money back into the business, really because of the lack of access or the cost of that capital. So the interest rate in which you would borrow at as a small, independent, micro cap pest control company is far different, let's say 11, 13, 14% at times versus a large private equity firm that's going to have a cost of capital far lower than that. Anything else, Paul?
Well, you know, I guess the last thing, and we can probably go on all day about benefits, but I think one of the last ones, and I think a really important one, especially for those guys who want to roll a sizable chunk and ultimately exit, you know, 3 or 4, 5, 6, 7 years down the line, or more importantly, the ones that ultimately want to go public, which I know is a very small amount. But you do get a lot of formalization in your business, right? If you partner with private equity, you're probably doing quarterly board meetings. You're probably doing monthly sessions with the operating team at the private equity firm. They're focused on making sure that corporate governance is set up appropriately, documents are in order, your firm's being audited. Just a whole lot of things get implemented in a private equity-backed business that don't otherwise get implemented in a family-owned private company. Even the ones that are doing 25, 30, 50 million, 100 million in revenue, they just don't have any need to do that. It could be owners, and sometimes it's a royal pain in the ass, but for the most part, it's preparing a business for a much larger exit at some point in the future. And I do think there's a ton of learning that comes out of that for sellers who will ultimately stay and operate that business. I think for the guys who are younger in their 30s and 40s, have built a pest control company, want to partner with private equity, and then ultimately exit. Now they're establishing their own personal track record, and it's going to be way easier for them once they exit once to be a founder who built a business, partnered with private equity, exited that business, now has some capital invest, can ultimately raise equity themselves, can go out and raise capital. It's going to be easier to raise debt and equity capital once they've been through that process and can go out and do it again. And I see that all the time. Like in our business right now, the guys that have exited, I see the guys in their 30s, 40s, and 50s go out almost immediately once exiting and get into another line of business or get into a very similar line of business with the intent to do it again. And with that experience and track record, I think it's a huge benefit.
Yeah, that's a great point. I've seen the same thing. And, you know, really there's probably that
I think we were just laughing about it the other day, you and I, as a matter of fact.
Yeah,
Somebody, yes.
Yeah, no, absolutely. And I know, some of the things you're talking about right now, there is probably a collective groan by a lot of these entrepreneurs who have just built these businesses from the ground up and haven't had a boss or haven't had these strict governance procedures, quarterly meetings, long presentations with their private equity sponsors. But at the end of the day, the private equity firms and even larger companies, public companies, they do go through these procedures and follow these guidelines for a reason. I mean, it leads to greater discipline and ultimately better business performance and a more sustainable, lower risk enterprise over the long term.
Absolutely. And you just raised a great point that I think will help us segue into the risks associated with partnering with private equity. And the point that you raised is the collective groan about not ever having a boss. And now that you're part of a private equity organization, now you report to a board and you've got a boss. And one of the things that I wanted to say as we kick this risk section off, Nick, is that every one of these private equity firms is created very, very differently. And they have a different philosophy as to how active they are in the management of their platform investments. So for example, in the pest control space, I've done transactions with private equity firms that are extremely hands-off, that really don't even have board meetings with the platform company. They'll have like monthly calls, check on numbers, so on and so forth, but they're not active in strategy. They're not active in day-to-day tactics. They basically high level oversee the president and his or her team and take a very hands-off approach. And then there are other private equity firms on the far other end of the spectrum that'll go out and hire an operating partner, and that operating partner's full-time job is to boss you around, the president of the pest control platform company. They're constantly bringing on outside advisors. They're having weekly calls, monthly calls, they're having quarterly board meetings. You're putting together a lot of paperwork and documentation, reporting back to the private equity firm. So it really is a spectrum. There's a lot that are in between. For the guy who has never had a boss and does not think he can report to anyone, clearly the private equity firm that is very hands-on is a very bad match, right? That person wants to go out and find the firm that is a little bit more hands-off in its approach to managing its investments.
Yeah, absolutely. I mean, the level of rigor that is possible and in certain situations, as you describe, with a private equity owner and the amount of reporting, financial discipline, accountability, and oftentimes it's really a attempt to maximize short-term value creation in that business. And the way they do that is through managing the financial metrics very tightly. And for some, as you point out, that can be very constricting and feel suffocating, quite frankly.
Indeed. What are some other risks that pop into your mind when dealing with clients about to partner with private equity?
I think in general, it's this loss of control. And you just touched on it, and I reinforce that point, but I just think more broadly, like having that full unchecked control of your baby, potentially your grandparents' baby that they created in your third generation, and now you go to sell, and then you have a big loss of control to a private equity firm with strict oversight. Okay, so I do think in general, the details that we're talking about really relates to just loss of control of that company and the future direction of the growth.
Yeah. When I think about that whole loss of control, Nick, it makes me think a lot about, again, going back to where you are on the investment horizon of that particular fund. Because if you're a relatively late stage investment, the private equity firm is going to be thinking about exiting from your business sooner rather than later. And so there'll be a lot more focus on short-term levers as opposed to longer-term value creation strategies. And so what I mean by that, well, look, because every one of these transactions is priced on cash flow, a very easy way to increase cash flow is get rid of manpower, right? Get rid of labor, get rid of overhead. And if I've got a 5-year investment horizon, as an investor, I might be less concerned with particular overhead on a day-to-day basis. But if I'm eyeing an exit 6 months from now, I might be trimming some heads in order to increase cash flow and prepare for an ultimate exit. So I think when sellers think about what private equity firms say and what their philosophy is, but what they might do, where you are on that investment horizon, meaning are you late in the fund duration, are you early in the fund, could have some bearing on whether or not the fund would be more short-term focused versus long-term focused.
Absolutely. Absolutely. I think that's a great point. And within that point, you also highlighted another nuance, which is essentially your team or your employees. So one potential risk of partnering or being acquired by a private equity firm is not only the employee turnover due to that short-term focus, but there could just be a misalignment in the culture and how the private equity firm views it, and then the desire to turn over that employee base to be more in alignment with their vision of the future of the company. Okay. So that oftentimes could be the case in that you have just more strict oversight of employees and their personal track records that could come into play when being owned by a private equity versus being owned by a private business owner.
Agreed. And I think to your point, we can almost look at the other side of the coin as well with private equity when it comes to employees. The other side of that coin would be private equity funds will oftentimes set up management and or employee incentive equity pools upon consummating a transaction. So to give everyone a real example, private equity transaction in Pest that I've done within the last year, I'm going to use round numbers here. Let's say that this was a $50 million transaction, 50 million. The private equity firm set up in addition to that $50 million enterprise value, they set up a pool that was worth $5 million in equity value today to be vested with a variety of different employees. And it typically starts at the top with management, like the top of the pyramid gets it first. So you've got some key managers. You have the seller rolls some equity. He's staying on as the president. You've got your key managers. And then as it trickles down the pyramid, lower level employees will get smaller portions of equity, but they sprinkled that pretty deep within the organization. So now you've got an organization where, unlike the business under the seller's ownership, or he owned 100% of that business, now the private equity firm owns a majority stake. The seller owns the next biggest slug, which was a minority stake. And now managers and employees own equity in that business. And ultimately, when they exit, they'll all exit together. And the great hope is that the key team members will also reap the rewards and the fruits of their labor in that investment.
That's a really good point. It can definitely create a lot of opportunity, both from a professional development standpoint, but as you mentioned, from a financial standpoint for the key team members. And oftentimes what you could also see is like once those team members are successful with that private equity backed company, they can then go on to other companies within the ecosystem of that private equity firm, which as an owner, you have to feel great about, right? You're creating new opportunities for your key team members while you're lowering your risk and getting compensated for all the work you put in building that business from zero.
So Nick, in addition to management and employee comp, it makes me think about one of the other risk factors that you and I talk about all the time, which quite frankly has a lot to do with the employment terms of the owners. And I wondered if you can go into that a little bit for us.
Yeah, sure, Paul. That's a good point. So I think that this risk is actually quite linked and married to a benefit. So one of the benefits that we talked about was the ability to take risk off the table, get a large check up front, and then roll a portion of your ownership or roll equity into the private equity backed pest control company. However, what typically can come with that is then you, as the manager and as the owner, you're still the CEO of the pest control company. And you might have an undefined term of employment with the private equity firm that's backing your company. So if you're an owner, you're happy about getting this rolled equity, but then you're continuing to operate the business, and it can be an uncertain time frame on how long you're going to be doing that. And it depends on a litany of factors, but oftentimes it can be linked to the overall exit strategy of that private equity roll-up. Would you add anything to that, Paul, that you've seen?
It's a wonderful point because, sellers always say to me, well, like, how long am I going to have to do this? And the answer to that question is no one knows, because like you said, it's tied to a massive list of unknowns. And so I think what's important for people to keep in mind is that, as Nick said, it's a benefit. You've rolled some equity. You're part of a bigger organization. It's less risky. They got more capital. You're part of an ecosystem. You're doing deals. You're growing this business. And they're going to be able to do a hell of a lot better job selling that business than you, because these private equity firms are sophisticated. They run controlled formal auctions every time they sell a business. They get top dollar high prices for these things, but you don't control when that exit is. And as we're going to get into in future discussions in this series, there's the concept of, drag along rights, for example, and tag along rights. And, the private equity firm will be the entity that decides whether or not they're selling that business. And so, for example, one of the key things that we've seen over the last couple of years is market conditions. Private equity firms are buying and selling every day of the week. And sometimes when market conditions are not ideal from a valuation perspective, from the debt markets, they will decide to not sell an asset and hold on to it and either build value or wait for better market opportunities to turn around and sell it. And now you, as the seller, might get stuck in an investment for an extra year or an extra 2 years or an extra 3 years. At the end of the day, you don't control it. And what we saw a lot of back in 2020 and 2021, as we know, the market was on an absolute tear in that COVID period, right? Mm-hmm. Government printing all this money, asset prices off the board. There were a lot of sellers that partnered with private equity and expected to do a 5 or 6 year run, right? This is what they're going to do. We're going to build this up, selling 80% of my business. I'm going to build this up for the next 5 or 6 years, and I'm going to be done. And they do a deal in 2019, and next thing you know, at the end of 2020, early 2021, with less than a 2-year hold, private equity decides like, hey, we're getting an offer for this business that we can't refuse. We're going to exit it in 2 years as opposed to the 5 or 6 years we told you, sorry, you're out. The good news was the sellers were delivered literally bushels of cash. I mean, it was a great opportunity for them to exit, but exit was premature and they had no control over it. So I guess that's the only thing that I would add to that, Nick, is there is some uncertainty and you do not have control. The private equity firm is in control of those exits.
Mm-hmm, absolutely. And it can certainly go the other way where the exit doesn't come. And what I've seen over time with managers and owners is that when the exit doesn't come, then it becomes very painful. And the focus of the PE firms becomes very short. Okay. And so in those situations, I think then it is definitely more of a risk.
Correct. So Nick, as we're kind of winding down this series, I know this isn't comprehensive. We're not talking about all risks and all benefits. I wanted us to go through some of the big ones. Is there any final risk factors that you can think about partnering private equity before we move on to structuring the deal in an upcoming session?
I would say the other, and this is a broad category of risk, but the other risk that frankly I've seen bite some people, quite frankly, and something that I worry about when I hear folks talking to private equity is a business owner, a pest control business owner, entering into a private equity transaction, and it's their one transaction, it's their only opportunity to sell this particular business. And they don't necessarily have a good attorney, they don't have a good advisor, and they go into this deal not understanding all of the various terms and conditions and what they're really signing up for when they're acquired by a private equity firm. And this isn't to say that private equity folks have any ill intentions in structuring these terms, but if you're in their shoes, what would you do? You would clearly structure terms that were most advantageous for you as the private equity owner who's buying this business. Okay. And so I do think it's critical to have an attorney who's been through hundreds and hundreds of transactions, and also to have an M&A advisor. Why not the biggest M&A advisor in the pest control industry, Potomac, which has done billions of dollars in transaction, to really understand the nuances of these terms and conditions that can be quite onerous for business owners if they're not aware of it. And I know, hey, that's kind of a plug for you, Paul, but I mean, it's something I really believe in.
No, I appreciate that, Nick. And, it's one of the most important things we do as we execute these deals. And, you bringing up that as a risk factor, I think is a great point for us to stop, because in our next session, structuring the deal, I'll have a lot to say on that. So until next week, Nick.
Sounds good. I'll see you next week.